with your losses that you inherit in a portfolio, you can use that to offset any gains, right?
Okay,
So if you've got active management in a portfolio, it's been a good year. If there's any rebalancing within the portfolio, you probably have some sort of gain within the portfolio.
Today's episode is brought to you by Security Financial Management.
Welcome back to Best Advice Podcast, guys. I'm your host, Rob Lavalio, here as always with Certified Financial Planner here at Security Financial Management, and Trevor Bell, aka Truck. What's up, baby?
Good to see you, my friend.
Good, man. You can hear I'm a little sick today. I feel like everyone's a little sick coming back from Thanksgiving.
Fresh off Thanksgiving, you know,
yeah.
Family, food, all the above. It'll get you the sickness for sure.
I feel like it was just like I'm like overstimulated from celebration.
Right.
You know what I mean?
Well, your birthday too.
My birthday.
Happy birthday to you. Happy birthday to you. Happy birthday. Happy birthday. Happy birthday to you.
The Hall of Fame.
Yeah.
And then Thanksgiving.
Yeah, you had a lot. That's for sure.
I'm going to come down. I'm going to get depressed now. I got nothing to celebrate.
Hey, there's always something to celebrate, right? You just got to look at it the right way.
I love that, baby. Well, let's get into the question of the day. Today's question comes from Stephanie. Stephanie, what you got for us?
Any advice or checklist items you would suggest as we close out the year 2025?
Thank you, Stephanie. Great question. And the year is obviously approaching. This is a big time to, gather all your important documents and make sure everything is in place. Truck, the expert, will you please kind of give some light and color to this question for us?
Yeah, absolutely. So one of the big things that we look at as the end of the year, comes to a close is tax considerations, right? So we've got April right around the corner. As soon as we get done with this year, tax season will be here and Uncle Sam will be knocking.
Yeah. Damn Uncle Sam.
Yeah, that's right. And so our job as advisors is really just making sure that your portfolio is adequately taking advantage of any tax loss harvesting situations. And what I mean by that is if you have any losses inherent within the portfolio that could be taken out so that you can carry forward that capital loss. And again, we're talking about taxable accounts, not necessarily your IRAs or tax deferred vehicles. But let's just say we have Target, for example, is down 15%, which is, of course, all hypothetical. But if that's down, we may want to sell that in the portfolio and go buy Walmart with it, right? A like industry company, for the sole purpose of taking advantage of the loss and then still having your portfolio invested within a particular industry.
So you're basically taking advantage of that loss, right? Accumulating that loss, but also keeping that same diversification, or the same allocation.
Right. Yeah, that's exactly it. And so with your losses that you inherit in a portfolio, you can use that to offset any gains, right? So if you've got active management in a portfolio, it's been a good year. If there's any rebalancing within the portfolio, you probably have some sort of gain within the portfolio.
It's crazy how much of a big of a difference that makes, like losing 20K or harvesting 20K,
right,
approaching it, putting it somewhere else.
Yeah, and that's kind of one of the things that we like to talk about too, is everybody gets so caught up in return with a portfolio, but are they looking at after-tax return?
Of course.
Because that's what matters at the end of the day is what you take home, what you actually gain, not necessarily what's your
all
return
paper
is
loss,
on a
right?
paper. Yeah, exactly.
So tip number 1 is make sure you're harvesting all your losses if applicable.
Right.
Let's go with tip number 2.
Yeah. Tip number 2 is really just maxing out your tax advantaged accounts before your deadlines, right? So we won't get into the weeds of catch-up provisions and actual contribution amounts, but just generally speaking, the max you can contribute to an IRA or Roth IRA is $7,000 in a year. If you're less than 50, you want to make sure to take advantage of that. Once you roll into 2025, you can't necessarily go back and say, hey, I want a 2024 contribution or I want a 2023 contribution. And given that you only get a set amount per year, you want to make sure you're taking advantage of that.
And the reason they give you a set amount per year is because they don't want you to take so much advantage of that and get like free.
Or else ultra wealthy individuals would pour $1 million into an IRA every year.
So there's a reason that they don't want you to, that there's a limit on all that. So AKA make sure you at least get your limit in there before the year ends.
Yep.
Is that what you're kind of saying?
Absolutely. And furthermore, for those that it is applicable to, you maxing out that vessel may even be a tax deduction for you.
Oh, yeah, it's true. True.
So, and again, those are all getting into the weeds with limits and stuff, but something to consider nonetheless.
Moving on to step number 3. Truck, what you got for number 3, baby?
So number 3, and this is going to apply, to our not elderly crowd, I shouldn't say that, but higher aged individuals, is your required minimum distributions.
Of course. Yes,
So once you reach the age of 73 now, you've got to take a required minimum distribution, meaning that's, again, here comes Uncle Sam knocking on the door, and he's
resilient.
Yeah, well, if that's how you look at it, right? But no, in all seriousness, though, the required minimum distribution is a set amount that we have to take out of IRA or qualified portfolios each year. And I'll tell you what.
If you miss that, what happens?
That's a great question. That's what I was about to dive into, Rob. So if you miss an RMD payment, let's just say for simplicity is $10,000 RMD, and you didn't take any of it, you could be taxed up to 50% of what you didn't take. That's $5,000 lost.
Bro.
Now, granted, if you fix it within the year that you made the mistake.
That seems harsh.
Yeah, it's harsh. It's harsh.
That
So
seems harsh.
they give you a little bit of leeway in terms of if you take it in the next year and satisfy the RMD, it's only a 10% penalty.
Still feels harsh.
It's
man.
still harsh.
Yeah.
It's still harsh. So you want to make sure you're taking care of those.
All right, Trucks, we're on a roll here. All right, we got number 1 is make sure you account for any of those losses you want to harvest if applicable for yourself, right?
Yep.
Number 2 is all your qualified accounts, make sure you max all those out, right?
Yeah, absolutely.
Number 3 for the older crowd is make sure you're getting your minimum distributions, right? So you don't want to hit penalties if you miss that.
Yeah.
Right. And then let's give one more. Let's give one more nugget, as I like to call it, or a little trick for the end of the year. What do you got for me?
So, and then actually this kind of dives into a past episode that we did, Rob, but really just generally doing a portfolio stress test. And what that means is, get it into a risk analysis tool, understand what your portfolio looks like from an actual risk standpoint. We've had a great year this year in the market. The past 2 years have been phenomenal. Maybe it's time to tone down some risk a little bit, and that may go directly with your gains or harvesting losses, because you may have shifts in the portfolio from an actual risk standpoint, but then you got to consider on the tax side, hey, am I going to sell this gain or this loss? How am I going to offset this gain with this loss or so on and so forth?
It's a good routine to get that and do that annually, all right?
Absolutely. I mean, I would even argue quarterly.
Yeah.
That's, of course, something that we do, but at least annually.
Yeah, 'cause things change, right?
Things change.
And I feel like after college, like the years kind of just start flinging by because you don't really have a Christmas break or Thanksgiving break or spring break.
It's not the same.
No, you got to get in a routine to make sure you're allocating appropriately.
Right. And that's all the stress test really is. It, tests your portfolio against different variables and says, hey, if we have a 20% correction in the market, here's what your actual portfolio would do movement-wise. And that's so critical for people from a tax element to a actual building net worth element. It's critical to say the least.
Beautiful. Well, great question, Stephanie. If you want to talk to Trevor or any of our certified financial planners here at Security Financial Management and want to start knocking out this checklist, please give us a call. We're going to leave a link in the description and a QR code right here. Remember, folks, the secret to wealth is not what you earn. It's what you keep. Happy days, everybody.
This podcast is for entertainment and educational purposes only and is not intended as personal financial advice. Before making any financial decision, please do your own research and consult a financial advisor as needed.